Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, and Ben Kingsley, Chair of Property Investment Professionals of Australia, and the 2014 and 2015 Property Investment Advisor of the Year.
All right, folks, you're on the Property Couch, your insider's guide to property investing, where each week Ben and I give you the insider's guide to property investing. Mate, I'd like you to refer to me as Owen.
Owen?
Owen 10, please. I'm just getting early.
Well, now, mate, we're coming to play you soon, and we've got no players. We lost 4 on the weekend. We might get one back in a couple of weeks.
Yeah, you guys. Do you know my wife bought me a Melbourne-based membership for the Fremantle Football Club? There's been 3 games that I haven't turned up to. The only one I'm going to turn up to is the one with you guys on Friday night, the 24th of June, just to check it out. So,
are we playing you at the G, are we?
We are, Friday night.
Okay. Yeah, so we've got a couple of W's hopefully coming up. Is that what you're telling me?
We could be 0-13 by then.
All right. What we got?
Winter is coming, you announced last week.
Yeah, I did. So we're going to talk about the property correction.
And rumour has it I didn't give you enough time to talk about Glenn Stevens' commentary last week as well.
Oh, yeah, all right. Well, that's where we can start. But I think what is it? Winter is coming and the air is going to be colder up high. See what that means. Oh, there we go.
There we go. There's a cryptic one.
I've done a bit of preparation for today's session.
Oh, well, 66 episodes, Iris. It's got to start somewhere.
I have actually got 3 things written down on a piece of paper in front of me. That is like the most planning I've ever done.
I have got to sit down. I have got to sit down and see this. Come on.
All right. So I want to refer to what Glenn Stevens said at a business luncheon, one of the last public appearances he'll be having. And he mentioned this belief that Australians have around property investing being basically the silver bullet, and that leveraging into property is a wonderful investment idea that's going to keep delivering great results. And I agree with him when he said he doesn't believe that it's going to be the same story moving forward. So everyone's going, wait a minute, this is property investment. It's going to be easy. Everyone can do it. It's all of the above. Well,
you just put your name on a title and wait for it to double every 7 years, don't you? That's what the guys in the presentations tell me.
They do. That's what the spruikers tell us. So the reality is,
I'm shocked.
And I'm going to spend a bit of time in talking about what I think might be happening in terms of the property space over the course of the next 18 to 24 months. Okay. All right. So first of all, and we also had a little email here from Vlad. Finding an investment. Hi, John Simons on 3AW predicted 10 to 20% fall in property prices if Labor's negative gear policy gets up. Given the uncertainty, is it prudent to wait until the election to make a decision on investing in property? Look, we'll come back to that, and Bryce did a little piece for Money Magazine on that one soon. But the point around the 10 to 20%, he's also said it on Money News, which is Ross Greenwood's show, and so did our little friend Roger Montgomery. He thinks it's going to be even worse. And if you can get any commentary from Roger Montgomery, he's on the money when we're talking about medium and high density apartments. And it might sound like a broken record for those of you who have been with us for a long time. And if you're completely new to us, listen to this podcast. But then if you're starting out with us, rip back to number 1 because there's a story behind all of this in terms of the why. So we're not going to unpack today in one podcast the why we don't like certain types of accommodation, but we'll touch on it a bit. So there's a few things I wanted to give you some stats on. You ready for this?
Whoop.
Okay, Melbourne property market, right? In the last 10 years, we've seen an increase on a decade average. On the decade average, we've seen an increase of 11.1% on new house builds. Okay, so building new houses. On the same 10-year decade average, we are 90.4% higher on the average builds of units that we've been building over that decade average. Wow. All right. Mm-hmm. I'll unpack that even further with some core logic data. And I'm just going to go city by city here, so we'll have some fun and we'll post this up on the website. So, capital city, in terms of the average annual unit sales in the last 5 years in Sydney, has been 43,442. The total number of new units in the last 12 months, so that's been the average over next 12 months, is 34,000. Now, what's even interesting about this is this pipeline of approvals that are coming through. There's 81,700 new apartments expected over the next 24 months. Now, if you think about it, you think 45 or 43 to 80, not too bad. Should be able to absorb a few of those. Melbourne, okay. We've had average for the past 5 years has been 30,000. For the last 12 months, it's been 29,500. For the next 24 months, 80,500 apartments in the planning and the pipe stage. Brisbane, the average for the last 5 years has been 15,000. For the next 12 months, it's going to be 16,600. But the next 24 months, 44,500.
Compelling.
Alarm, alarm, alarm.
CBD stands for could be dangerous.
Could be dangerous. Adelaide, not too bad. Average for the last 6 years, 6,100. Next 24 months, 6,000. So on par. Perth. Average for the last 5 years, 6,800. Next 24 months, 13,000. So
almost 14.
Yeah, almost 14,000. Hobart doesn't exist. Apartments don't exist. 442 apartments.
Lucky you qualified that.
In the next 24 months. Darwin, settling down. Long-term average 1,000. Seeing basically 1,200 over the next 24 months. Canberra, almost 4,000. We're seeing only 3,000. So a slowdown in Canberra after their oversupply. If you talk to any Canberrians, they'll tell you that apartments were oversupplied probably about 12, 15 months ago.
We saw it when we were there 3 weeks ago. We just drove past heaps of construction.
We did, and so that'll also play itself out. So the average across all capital cities over the last 5 years has been 108,000, and in terms of the last 12 months, 92,000. But in the next 24 months, we're seeing 231,000 apartments. Now, what we've got to say here is it's really important because I'm putting this conversation up with my next door neighbour. Now, it just so happens that my next door neighbour is a very active member and lawyer in the property space. So he runs and does lots of apartment developments. And he was telling me over the fence when we're having a chat that there's real problems. The banks are just tightening up completely on funding for medium and high density apartments. Now, that's not the funding to the foreign investments. That's another story. That's another story, which is why winter is coming for this particular marketplace. So when I hear on the ground that the banks aren't lending funds, and what he was interesting to say, he goes, Ben, I want to put deals together, but what I'm actually doing at the moment is more litigation. So I'm seeing more rescission notices on these development sites. In fact, he quoted a $600,000 deposit being rescinded on a site purely because of the fact that they couldn't get funding for it. So they've done their dough. Now, what happens in these property cycles, ladies and gentlemen, is you always overshoot. So even the small-time developer, the mid-range developer and the high-end developer will usually think that this is going to continue on, and they get a little bit more active and they pay a premium for the sites and then they start to build them, and it's still good because we're getting some of the pre-sales through. But when the valuations start to change and start to not come in as bought, we start to see that concern around the validation of the purchase price and holding value. So then we start to see the correction come.
Australian Financial Review on Saturday quoted that some properties that have been bought off the plan they paid back in 2009 currently have down 24%. And one of the most prominent valuers in Melbourne was chatting to you the other day. We had that conversation. And 1 in 2 properties that are off the plan are valuing under. And when you told me that stat, I was surprised, but for the reasons you didn't expect, because I thought it was a little low. I thought it would be actually higher than 1 in 2. I thought it would be more like 3 out of 5 or 3 out of 4.
I think it's going to go that way, and I think what that is a combination of, because just recently, I think it was Lendlease released some properties in downtown Sydney, and they sold, and don't quote me on this, but I think it was about $480 million worth of property in one weekend, right? Mm-hmm. And these properties...
Who sold it, Frederick Eklund?
And these properties were, going to have harbour views and opera house views and so forth. So the reality, bridge views and the whole bit. So when you get an asset like that, there is scarcity value in that. It's never going to be built out. Okay, so all of the land in front of what they were looking at is never going to be built out. So there is always exceptions to the rule, even on medium and high density apartments. So if you were buying one of those And you saw the interest. I mean, to sell that out in one weekend is extraordinary, right? And you're seeing people understand the value of icon images. So if I can see the bridge or the Sydney Opera House from my room, and I'll never be built out in terms of there's open public space in front of me or whatever. That is scarcity. That's true scarcity.
But I'd still caution on that, because even if you think about Eureka Tower here in Melbourne, which is an iconic building, it hasn't moved that much, and it costs you, $20,000 to $40,000 a year just to live there, even if you own it outright. So that's often the fundamental problem with it. So it creates lifestyle, but as an investment, it's still problematic.
Now, so Eureka's a slightly different story for me, because in the end of the day, it's 360 views. It's a big, it's big up view. If that, for whatever reason, that had that sort of channel view into the harbour or into whatever, and it was an iconic view, a global view, then I suspect you'll get that separation in terms of supply demand. So I actually think that those properties there would be a rare exception where they'll perform reasonably well if they're tightly held. But I agree with you in terms of don't forget the holding costs and the concierge.
Yeah, because I was going to say, because Australians don't.
Not straightforward.
It's not a Manhattanisation of our cities yet.
No.
So in New York, no problem, but in Sydney, I personally would still. I'd still approach that with caution. Lifestyle, owner-occupied, no problem. If you've got the cash to pay for the lift and the pool and the expensive body corporates, even if you own your unit outright, no problem. But as an investor, I'd still think there's better options.
So the positive stories for this type of construction, and as we're talking about 90% above the 10-year average, what I'm talking about there is this whole concept that we're going to have this oversupply for a period. It eventually gets absorbed. We were talking back in 2013 with ANZ and seeing their projections around. There was 1.3 million people that are going to move to Melbourne by 2028, right? And another 1.2 million moving to Sydney by that time. So these are, again, we talk about mega cities. They are going to be mega cities. This accommodation should be absorbed, but this is a whole timing issue and, again, about performance. So why we wanted to talk about this, and we've got clients who might be sitting back going, oh my God, does that mean my little unit in block of 10, block of 18, block of 12 is going to also suffer? Well, if we play this out from a sentiment and confidence point of view, the media will get onto this and it'll start to hit the mainstream media. And so all of those stories about bubbles and, it's happening now, the crash is on, that'll start to change sentiment. And that'll start to put doubt in people's mind about what they're executing on. So if you've bought one of these off-the-plan apartments and think that you're going to get this uplift earlier because you saw some other friends who bought in 2013 and they're about to settle now and their properties have gone up, and that's been the case in some of the Sydney markets, I'm going to say to you that's a paper result, and potentially you'll probably see a bit of a correction in that because the confidence in this particular market will be shaken. Now, you get that confidence shaken, it only naturally has a flow-on effect into your standard single boutique type accommodation. But remember, we only need two competing interested parties on that type of property, and they understand that they're not living in a hotel room. They don't have all of that extra cost about it. And so there could be some really good buying opportunities in that particular space. And we've known that, if we look at the last 12 months data just here in Melbourne as well, 10% growth in houses, so sort of freestanding or villas and townhouses, and then we see flats and apartments, or mainly apartments, which is really the majority of the data we're looking at, has only been up 1.2%. So this is the consequence of supply demand. And this is the reason why in our business, we've never followed these sort of short-term trends. What we do in terms of the research is we're playing the long game. We're talking about being a borderless investor, so we're not playing in these markets which are going to be oversupplied. We have been buying, boutique stuff up in Brisbane, and we're still very confident about that over the long game. But we do know that there might be a shortage of, a vacancy position on those. But we're playing the long game on those ones. So if we come back to that point, we've always taken the view that if you buy well, and you buy what I call low compression risk stuff, which is the freestanding houses, the existing homes, you can back test the performance, you can do all those type of wonderful things, and you can test it, that on average our clients are going to be better off. Now, we're not saying we're experts or supreme scientists and we know the perfect science for every property investing. What we're actually just saying is we still think that some of the prices could come off their highs. I mean, I've lived through enough cycles to know the 2001, 2003 cycle was an even stronger cycle than the one we're in right now. It doesn't feel like that from a percentage point of view, but from a value point of view, it's huge because we're talking hundreds of thousands of dollars more because the sheer value of properties is so much higher. So I just wanted to make sure we had this conversation because, you know, you're going to, if you're out there thinking, who do I go with? What do I look at? House and land packages are also the other types of accommodation that can be brought onto market fairly easily. And you've heard us talk about the challenge with house and land packages is you're in land locations which has usually an abundance of land, so there's no scarcity attached to that.
Yeah, no, good point, Ben, because, you know, I always think that if the properties that we're buying, if the market is underperforming, where the properties that we're buying are going to outperform the underperformers. So do you know what I mean? So if everything's dropping down, the ones where, because, you know, at the end of the day, you know, the scarcity, the owner-occupier appeal, and the investment grade, they stack up in any condition. So, and it's the long game. I had to write an article for the Money Magazine. It went out today in their EDM and the electronic distribution message. And it was said, should we buy before the election? I said, only if it's part of your overall long-term strategy, and as long as you consider short-term to be 10 plus years. Which is
what Vlad's question was.
Yeah, absolutely. So, I mean, because a lot of people could have egg on their face if they try and buy pre-election, they cause a little pent-up demand, a little mini boom, and then, as I said in the article, if the current government doesn't change, all the anxiety and everything would have been for nothing because we know what the Liberal Party's policies are. So I just think it's still play the long game. Even if the Labor Party does get in, you've still got 12 months to get into the marketplace. And I think it's important that no matter what you're doing, long-term strategy is always paramount, but do not compromise on asset selection in any conditions, in a boom, in a bust, in an equilibrium. That is the number one constant that should always stay the same.
I agree. So how big is this correction going to be? This is interesting for us. The reason why I say it's interesting is because we haven't seen interest rates as low as what we've seen them right now. So, you know, if interest rates were higher, it would be pretty messy. It's still going to be really messy in some pockets of the market where people get into a negative equity position and they are forced to sell, or they have to move into it and then rent their family home or whatever it may be. I mean, that's the sort of stuff we saw in the Docklands many years ago, and it's happened on occasion at the end of the boom in 2004 in Sydney as well. So because we're in this low interest rate environment, we still think that it may not be as chronic as what we've seen in the past. But then when you start to unpack the whole story behind that, and by that I mean, okay, we're in a building boom, all right? Those numbers I just talked to you about, 231,000 versus the average over a 5-year period is 108,000. So some markets better than others. This is the transition that we've had from the mining boom and the capex in mining. And so this has been a good transition. It hasn't been a hard landing yet. But once the confidence and the sentiment changes, and then potentially the pre-sales don't come through, and then the product doesn't get out of the ground, and then you factor in the Chinese buyers who are now struggling to get finance here in Australia, we've got a problem. Because 1 in 4 jobs in Australia is related to property. So, you know, you think about it, the truck drivers who are digging the holes, the concrete suppliers, the carpenters, the builders, the welders, the steel makers, all these people have a direct relationship with this type of infrastructure. And that is, you know, then you've got the retail and so forth. So retail's struggling out there at the moment. This could be the catalyst for that R word. This, if we think about this and play this out further, all of a sudden you get this whole confidence score and sentiment changing around people's property values. And it's called the wealth effect. Okay, and what I mean by the wealth effect is that households, they have this ability when they feel comfortable to go out and spend money. Discretionary spending, usually. Not necessarily just on the home, but, you know, if they feel okay, job security's there, house is going up in value, life's good, let's go out and enjoy ourselves, whether it be go and have a dinner with the family, that's discretionary spending, or go and buy a pair of shoes or a new golf driver, whatever it may be, that's plays on. Now, when you see that change in confidence occur, this wealth effect starts to kick in, and that is, I no longer feel as wealthy as I used to, okay? And when I don't feel as wealthy as I used to, I stop spending. I stop spending that discretionary spend, and that's flow on jobs, and that's GDP. Now, we only need 2 negative quarters of GDP, and we're in a technical recession. All right. So, what is then playing out potentially over the next 18 months to 24 months? And I'm cautious that we're going to go very close, if not into a recession. I'm almost positive, and I'm putting myself out on a chopping block here. But if we have Labor get in, and they introduce a negative gearing policy, you're going to see, because everyone starts to learn that the dud investments in property are high-rise and medium density accommodation or house and land packages. Once they start working out that they're dud investments, people aren't stupid. They're not going to chase a tax deduction and get a bad investment. So once more and more data is released on, how well that block's performed or how well that high-rise, because that's coming, because we've got the sales history of every one of those properties. So that data will start to be released further and further, and people will start to see that what we're saying is true. They'll start to say, well, I might put my money somewhere else. Now, the irony of that is they're going to put their money into the stuff that we try and buy, which is existing properties in good locations close in, scarcity value, owner-occupier appeal, and investment grade. So, just by doing this podcast, we're putting more competition in the types of properties we want to buy for our clients. We're happy with that because we want to see everyone have smart investments in property. I'm also happy with the fact that it does, we do need, you can't have a sustainable market where 50% of the population is investing in property. That's just crazy. But because there's no, we're getting poor returns on our term deposits. There's no really, strong returns. The market's a bit choppy, although it had a really good May. They had one of the best Mays for a long time. We're starting to see this sort of challenge around, what that's going to mean. And that's the psychology that is going to be, really important about taking the economy and taking us forward. We live in a very fortunate country. We have, in terms of living standards and wealth per capita, we're right up there in terms of what that looks like. So, I tend to agree that there's because we've been 25 years of this positive economic growth, we haven't seen what it's like when people start losing jobs and when things like so, and so we don't necessarily have an appetite to want big change, and we need to make changes to our tax system. We need to make our economy more competitive so multinationals don't pick Singapore over Australia. They want to come here because I'm a small business operator. You're a small business operator. We own a small business. The reality in the small business that we own is that if we own a small business like a coffee shop, you're right, 5% tax deduction for them is going to be what, one bloke said $8 a week on Q&A. Right? That doesn't mean much to him. But for us, that's potentially, $50,000, $60,000. That's someone who we can employ. That's possibly 2 people that we can employ. Okay. So my view on this, and I know I'm probably a little bit on my high horse at the moment, but the reality is that everything has an interrelationship. Property is a fundamentally an integrated part of our overall economy. It touches so many touch points that if we think that we can all go and invest in it and make a fortune, that's not going to happen. If we're strategic about how we do it, that can happen, but not everyone can play in the same space. So that's a big wrap up, but come back to Glenn Stevens' point. He goes, is it viable that everyone takes on all this level of debt to get into property investment, and is that going to be a viable thing? Well, his models are right. We can't have 50% of people getting in and doing this. We need to slow it down. It's only going to be for those people who see it as a long-term investment, and we get rid of the speculation, okay? And over time, some of these cities, as this population grows, I think there will be a more of an acceptance towards apartment living. But the reality is right now, where are we going to get our best returns? We're going to get those best returns when it comes to smart asset selection.
So I guess some of the general commentary around property prices falling is because it's easier to describe that, isn't it? But I guess for our listeners, the stuff that we're teaching people to go and buy is the stuff, as you said before, that's going to be more in demand. I think Bernard Salt says it best when we listen to him. He says, whenever there's noise, I just refer back to the facts.
Yeah.
And using Melbourne, for example, which is probably suffering some of the worst sentiment outside of the state, because we are oversupplied with apartments, and the Leafy East is probably already at full value. So, as we always say, we're not buying Melbourne, we're buying a localised house and a localised street. So he says last year it was 89,000, the year before it was 93,000, the year before that was 92,000 people net moving here. So where do those people want to be? They want to be in the epicentre, and then they'll move further out based on affordability.
Correct.
But the closer you are to the epicentre when the rock drops into the pond, that's where it's the strongest and the smallest radius around it. So that's why the stuff that we're buying is still okay. But we are going to have to be aware that clients who are listening to this, they are going to, we talked a few podcasts ago about the headwinds are coming. We talked about winter is coming today. The headwinds are coming for their mindset to stay strong and keep their nerve because, again, international city, 90,000 net, buying good properties in some of the best locations. There's some, if the labour rules get in, it means where they're buying will become scarcer and scarcer and scarcer, but they're going to have to hold their nerve.
Correct. Markets within markets. So the big headline, Melbourne prices crash, apartments in Brisbane crash prices across Brisbane. All of those things are going to be the big one-liners. But those markets within markets that we talk about, we can actually study the different types of accommodation by market and by suburb. So an example would be, I studied heavily that 2001 to 2003 boom that Melbourne and Sydney had, and I looked at some of those inner city areas. Now, I saw certainly a correction at the absolute elite level of the market, so that top 25% of values back in those days in that 1 to 2 million range. And so values in that sort of 5 million range will probably take a bit of a hit when we get into recession because that's that confidence thing of bonuses and sort of just securing my really high paying job. But I also then say you get back into the nitty gritty of these beautiful sort of inner 5 to 10 kilometres, 15 kilometres from city, these suburbs do reasonably well. And unfortunately, the carnage is in the outskirts. And I'll explain to you why. What Bryce was saying before about affordability is an important point. Because when we've got double household income and we're just starting out and we're looking to buy our house and land package, our first home, usually our money will buy us, if we're sold to the earth Australians, it's going to buy us something on the fringe. Okay, so that's our step on the ladder. Now, the reality for those people, when we look at them, they're in their early to mid 20s, in some cases late 20s, but they've only potentially been in their career post-uni for about 2 or 3 years. Now, they don't have the skill sets or the wealth of job knowledge to sustain that job. So if there is people who usually get laid off, it's going to be the lower skilled people, because the higher skilled people are potentially going to be able to cover the workload, even though they're not going to be happy with it. So what you then see is this type of confidence, and the unemployment rates in the outer areas actually go up a little bit higher. So these people then have monetary problems. We're starting to see delinquency rates starting to increase, and you can study these little pockets of where that's type of things happening. So you might have had a really good run in this current bull market, where your paper profits, your so-called artificial value on your home, because you're not selling it now, is worth $700,000. Don't be afraid in some of those outer areas, Western Sydney markets. Now, Sydney's got a better story around its economy and some of the infrastructure going out there, but I would suspect some of those areas are going to see some correction. And if I go back to my data from that time, they had big corrections in that time frame. But some of the inner city areas, the Paddingtons, the Darlinghursts, the Surrey Hills, the Glebes, the Balmains, the North Sydneys, the Wallaras, those types of areas actually didn't have the same type of correction of what the broader market. But, because we can't digest that in one 30-second news story, but we can digest it even in the paper. We only want the big headlines that can get through. Sydney prices off 15%, Melbourne prices off 18%. That's not a true reflection of markets within markets.
Very good point. So what's your message then to investors looking to buy now?
So we're still playing the long game, borderless investing. So we've really honed in again on probably the sort of troublesome markets, which will be Melbourne, Sydney, Brisbane. But there are other markets that we would certainly be looking at. Markets for me right now, playing the safe game, is to sort of find markets where there's a reasonable amount of demand for rental accommodation. So we want to make sure we've got that sorted, and where affordability is still relative to incomes, where the emotion and the roller coaster ride hasn't occurred. So there's still some uplift in terms of being able to afford that. Because what we will know that if we do go into that R word, we will definitely have lower interest rates. Okay, now that won't change assessment rates because APRA is all over it and the banks are all over it because that's how you get a GFC. So they'll stay high, but it will mean there will be some cushioning and some comfort around lower repayments on our mortgages. But that's not a good thing for the economy. If we're going lower interest rates, there's problems. Okay, we want to be in a better position from that point of view. So my view is, I've always held this view: you invest when you can afford to invest for the short and long term. Okay, there's absolutely opportunities in every market. In fact, in 24 months, 18 to 24 months, Melbourne and Sydney will potentially become a very interesting market to buy in. So when others are greedy, be fearful, and be active when others are greedy. How does that statement go? What was it?
Be greedy when others are fearful, and fearful when others are greedy.
Good old statement from Warren Buffett. So that's the sort of message. We are still absolutely buying for our clients, but we're being obviously very particular about what we're buying, where we're buying it, and we're working on those fundamentals of supply and demand as best we can.
There's no secret. I mean, the listeners can just go back and rewind and go back to the principles that we've been talking about for 66 weeks.
Yep.
That's the thing. It's not hard to work out which ones to buy. So there you have it, folks. You've got to hold your nerve. You're playing for the long game in terms of where you're buying, and don't get caught up in the headlines because there's going to be a lot of headlines coming. Is the message, isn't it, Ben?
It is. It's a really, it's an interesting market. We're going to move from a seller's market to a buyer's market into the future. And that's okay. So people might be thinking, oh, that's it, I'm just going to hold all my cash back and I'm going to wait for this to come. Well, the question is, will it come in that existing property stock? That 3 or 4 bedroom house in Northcote, Thornbury, that 3 or 4 bedroom house in areas of Sydney, say East Lakes or those types of areas. Will it come to those markets as heavily as it's going to come to the oversupplied accommodation? I doubt it. So I'd still be sort of saying play the long game, but be watching the market in terms of the number of people, the open homes, what's going through, how many bidders are happening at each auction, and be in a situation where you can learn whether the market's ramping up or whether it's slowing down. Because we saw it slowing down at the end of last year. We've had a psychological boost by a lower interest rate in last month. And so now we've got this situation where maybe confidence is a little bit higher. And I think we're going to see a pretty good GDP number tomorrow. If you actually have a look at the export-import data, we're going to see that number could be reasonable. But I suspect the one I'm looking for and I want to be watching of late is going to be consumer spending and consumer confidence, because the media are going to have a field day because they don't like a balanced market. They either like a booming market or a bust market. So that's what we've got to look out for.
Very good. So there you go, folks. Hold your nerve. If you've bought properties on the principles that we've talked about, you should be fine. If you're holding some of the other stock that we've been talking about for the last 66 weeks that's vulnerable, well then you obviously need to plan for that accordingly. A couple of things, Ben. If people want to join the conversation around what we're talking about today, they can do that on Instagram, Facebook, or Twitter. The reason I say that is because we love to interact with our community, but we're also going to do a Facebook live chat.
Oh, when?
On the 29th of June, Wednesday the 29th of June at 8:30 p.m.
I better put that in my diary. I'm even writing it down.
Standard
29th
time.
of June.
Will you turn up?
I'll be there.
You'll be there. So, because we get lots of Q&A and we love to do Q&A all the time, but that's going to give people an opportunity to do it live. So if they want to put that in their diary, but better still, go to our Facebook page, thepropertycouch.com. No, not thepropertycouch.com. Go to facebook.com.
Usually Leo doesn't know what's going on.
Facebook.com, and then go to the Property Couch and like us, because we will build it up and we'll remind people.
So is that facebook.com/? The Property Couch? How's it work?
Look, you get technical. Just go to Facebook and then search for the Property Couch. That's all you need to do. And Ben, we're also going to do a vodcast.
Yes, I'm looking forward to this one.
Ben is very much looking forward to this. So what's a vodcast? We've actually got our set here in our little studio here in North Melbourne, and we are going to record an episode of the Property Couch on the couch. So
on the couch.
Actually see our couch.
We bought a couch.
They have to imagine what our couch looks like. Soon they'll be able to see it. And that will be something that...
you mean, so not the armchair like we've got on the website?
Well, actually, the chair does look...
well, that's one of the chairs, but there's a couch next to the chair.
There's a couch next to it, exactly. So, folks, lots of cool stuff coming up here on the Property Couch.
We've got a new concept too, isn't it? We're going to launch the concept?
We are.
What's it called?
I don't know, your story.
We're going to talk about the practicality test.
Oh.
Yeah.
The practicality test.
Yeah. That's in the vodcast.
Understanding the value chain.
Yeah.
And unlocking the practicality test.
Oh, there's lots to look forward to. When are we doing that, Iris?
She doesn't know. She's panicking.
She's hyperventilating into a bag right now. All this work that I have to do.
Hey, 500,000 downloads. We're on track for the end of July. But we would love to ask a favour. We haven't asked a favour for a while. Let's see if we can get to 500,000 downloads by the end of June.
Woo!
30 days left. Tell a friend. If you like the podcast, we know lots of people are writing in saying that they do. If you could tell 2 friends.
Yeah.
Tell 2 friends about our podcast, or write a 5-star review on our iTunes account. All it does means our little algorithm goes through and makes us pop up in a few more feeds. So that'll be really nice.
That sounds like a plan.
Sounds like a plan. So there we have it.
That's it. It's a wrap. How we go? And we're almost on time.
No,
not quite. No. We had someone tell us that they should go for an hour. I got reached out on a private message on one of the forums, and they said, "Oh, can you make it an hour?" I think it was Vlad, but I'll respond to you, Vlad. I always try to respond to anyone who emails me. So
we've got some listeners who probably that's a bit much for them.
It's a bit much for me.
You and I bang on.
Well, yeah, you know.
So, but can you remember the early days? So it was 20 minutes we tried for. 20 minutes.
15 was the original.
15 was the original, was it?
Go back to some of the first ones. I reckon they're 15.
Oh, we've grown.
We got so much to say.
All
right, so is it my turn?
It is, mate.
All right, so Norwegian. Norwegian. Have we done Norwegian before? Anyway, I don't have a tick next to that.
I was about to say, mate, it's an old school system. You just tick the ones you've done.
Yeah, so I better tick this one once. I just put a circle there because I hadn't done it. Norwegian, is it Farvel?
Oh, there we go.
Farvel. The harder one might be Hadebra or Hade. No, that doesn't sound Norwegian, does it? That's almost like Arabic.
Sounds Samoan.
Hade. I like that one. That's the easiest one. Farvel.
Yeah.
Farvel.
Did you hear the French?
Norwegian.
Oh, folks, we are 2 grown men, and you'd think that we were still in primary school, wouldn't you? But that's okay. You got to release your inner child and have a little fun. So for those of you who still hung around, I know imagine if we could graph those people who listen to our podcast, and you could just see us go, maybe rise, they catch it,
They turned this off 30 seconds ago.
They bang. The music kicks in, they go, fair dinkum. So there you go, folks. Thanks for hanging around, those who did. And until next week, 2 things, go Freo and
Farvel.
Farvel.
Go Pies.
There you go. See you, folks. See you next week.